Hello everyone, welcome to this new session of CFA Level 2. Today we'll be covering the remaining portion of our reading from FRA, focusing on employee compensation. Now in the first training itself, we looked at a few details about the projected benefit obligation, the PBO values, and how we calculate them, how the present value of all out of compensation would be decided. Today we'll be looking at the remaining portion of our major calculations, which is plan assets. So whenever the company is having a defined benefit plan, they have some obligation that they will have to fulfill when the employee decides to retire. For that, they have to not only maintain the record of how much that obligation is, but they have to also match that obligation with some investments that they do on a regular basis in some assets. Those investments are called plan assets. Today's discussion is primarily going to focus on what those plan assets are, and then we'll do a comprehensive example to merge all of the concepts that we've covered so far. So let's start with the discussion of plan assets and funded status. So both the topics together. Now, whenever a company has a defined benefit plan, they have two components. One is the PBO, which is the liability part, how much obligation the company has for the future. And then they have plan assets, which is where the company is investing its money so that when in future they have to pay the pension, they will have the funds. So both the components have a very important role. And for the company and for the management, it is of utmost importance that both of these are managed. For that, we have something known as funded status. Funded status is simply plan assets minus PBO. And the idea is very simple. If this calculation gives me a value which is less than zero, which means my benefit plan is underfunded. So if this value comes out as less than zero, we call the plan underfunded. It simply means that the obligations are more or higher in comparison to the assets or the investments that I'm making to cover those obligations in the future. So underfunded simply means that the company's investments are not quite matching up to the obligations that the company has. And if they don't correct for it in the future, when those obligations are to be settled, they might not have assets to settle those. They might not have resources to settle those obligations. And if this value comes out as more than zero, as a positive value, at that point, we call the defined benefit plan, the entire pension plan of the company, to be overfunded, which means the company has excess of investments in comparison to what the obligations are. Now, under ideal circumstances, I want the plan to be slightly overfunded, mainly for risk management purposes. But for the company to have a very highly overfunded plan would also be bad, mainly because they have too much excess funds that they are not investing for business growth or anything, but rather just investing to meet the pension obligations. So I don't want that situation either. So the idea of the management is they want to calculate the funded status, compare the plan assets with the obligation part, and try to strike a balance between them. If at any point the plan is underfunded, the intention of the management is to increase the funding, to make more contributions, make more investments, and bring the plan assets up to match the obligations. And if in any year plan assets are higher than the obligations, it means I already have more investments. That gives the management a little bit of freedom that if they want, for a few years, they can make less contributions to the investments, mainly because the investments are already high in value. So as such, I don't have to every year make same amount of contribution. If the assets are already high, I can maybe reduce the contributions I'm making slightly. Now, both of these values, PBO and plan assets, they have a set of calculations. So these both appear in the balance sheet. We'll have a discussion as to how or where exactly do they appear, but both of them have a basic calculation. So PBO is calculated as simply the opening balance. So whatever the balance is from the previous year, opening balance, then we add current service cost, we add past service cost, we add interest, we add actuarial changes, all of these will be adjusted. Actual changes can be both positive or negative depending upon how the change in assumption is. And then if any ex-employees or if any people are being paid pension, that would reduce my obligation. So if someone has already retired and I'm starting to pay him pension, whatever pension I've paid him is reducing my liability. So that payments, the benefits paid, is going to reduce my obligation and I'll have closing balance. And for the assets as well, the calculation is fairly basic. You have opening balance. In this, you add the contributions made by the company. So basically, any additional investment made by the company during the year to add to the plan assets so that in the future when obligations increase, they are also matched. Those are contributions. And then you also add interest earned, because any interest or any returns that these investments earn, those are assumed to be reinvested in the same plan itself, so that in the future, by way of compounding, we have a bigger asset base to settle our obligations. So the interest earned will also show up here. This would be the actual interest that you have earned. Now, just like benefits paid would reduce my liability, I actually will be paying those benefits primarily from my plan assets. So they would also reduce my plan assets. So over here we have benefits paid reducing my plan assets. And then you will have your closing balance. Now the good thing is funded status, the calculation is same. It's plan assets minus projected benefit obligations. This can be calculated either on the basis of opening balance or on the basis of closing balance. So you have opening funded status and you have closing funded status. And throughout your entire calculations, the logic of all of this is that on the basis of these values, now these values are going to be reflected in balance sheet. In balance sheet, this is liability, this is asset. But I'm not just interested in having assets and liabilities. If I'm maintaining a defined benefit plan, I also need some amount to reflect in my income statement as a periodic cost that I am incurring. So every year, how much cost am I incurring to maintain my benefit plan? So these are just opening, closing balances and everything that changes. Now I need to filter out some of the details that will be also showcased in the income statement as my expenses or revenues. So for that, we have a very basic calculation which is known as total periodic pension cost. This is sort of a value which represents how much expense in net basis is the company doing to have the benefit plan maintained throughout the year. So effectively, this is not the exact amount transferred to P&L. This is just the net cost a company has incurred during the year to maintain the benefit plan. And there are two ways to calculate this. The easiest way is contributions, which is this value, minus ending funded status minus beginning funded status. Now this basically implies that if you look at just this value, ending funded status minus beginning funded status, this is telling me how much on a net basis do I have additional plan assets over my obligations. If we for a moment just assume that in both opening and closing balance, we have an overfunded plan. Now in that case, if I'm increasing more plan assets, it simply means that I'm making more investments than what is necessary. If the total amount I'm contributing is, let's say, 1,000, and during the year my assets have increased by 200 over what they actually are supposed to be, it means that out of the 1,000 that I've invested, the necessary amount was only 800. The 200 is just an additional contribution that I'm making to increase the plan assets even further. So effectively, the idea of total periodic pension cost is what is, in an ideal world, the amount of cost a company should have incurred during the year for upkeep of their defined benefit plan. So you have these calculations. Now, if this doesn't make sense, there is an alternative calculation which I'm sure will. The alternative way of calculating all of this is to simply use all of these values. So I have current service cost plus past service cost plus interest cost plus minus actuarial changes and minus return on plan assets, which is the interest on this value. So if outright the first formula doesn't make sense, second formula is easier to understand logically. And if when you look at both of them, they are doing the exact same thing. The only difference is one is focusing on contributions and opening and closing balances directly. The second formula is splitting over the entire reconciliation. So it is saying instead of looking at opening closing balances, the second alternative is saying let's look at all the components that would cause a change in the funded status itself. So whether you follow the first formula or the second formula, both of them will give you the exact same answer. In the exam, my suggestion is for questions that you practice, try to apply both of them so that you have clarity on both, because sometimes the question could not give you all the information for a smaller question. They could just give you closing balances of both plan assets and PBO and opening balances and contributions. So in that case, the second part might not be applicable. So you have to be prepared to practice with both of them so that you're comfortable in an exam, so that whatever the question might give you, you're able to adapt to that situation. So the amount that you get after calculating this, that's basically the net amount a company is supposed to have as a cost to maintain their defined benefit plan. Now, the good thing is, once we have all of this discussion, there is just a few normal elements left, primarily discussing the differences in IFRS and US GAAP. So the first thing is, both IFRS and US GAAP, they say always net the balances and show just a single amount. So if your plan is overfunded, you show an asset. If your plan is underfunded, you show a liability. So you net them and then show just one singular amount. Aside from this, when we transfer the amounts one by one to our income statement and OCI, because all of these amounts are going to be reflected in those statements as well, the difference in IFRS and US GAAP is mainly in terms of what amount will showcase in P&L and what will showcase in OCI. So current service cost, both IFRS and US GAAP say transfer it to income statement. Past service cost, IFRS says income statement, US GAAP says OCI. And US GAAP also says that if you're transferring this amount to other comprehensive income, you should amortize it over the remaining useful life. So if your plan has a remaining life of, let's say, 20 years, then whatever the amount of past service cost is, US GAAP says transfer it to other comprehensive income and then amortize it over the next 20 years. Then you have interest. Both IFRS and US GAAP say transfer this amount to income statement. How do we calculate this interest? It is simply opening balance multiplied with discount rate. We've already done this in the previous class itself. So this is how the amount is calculated. Then we have actuarial changes. Over here, both are saying transfer it to OCI. So both IFRS and US GAAP say that this amount is supposed to be transferred to the other comprehensive income. However, US GAAP also says to amortize if the corridor approach is satisfied. Now, what exactly is corridor approach? US GAAP says that whatever this amount is, compare it with the opening balances of your PBO and plan assets, and whichever is higher out of these two. If the amount of actuarial changes is more than 10% of that higher amount, so 10% if actuarial changes more than 10% of PBO or plan assets, whichever is higher, then US GAAP says that this amount is significant and you should amortize it over the remaining useful life of your pension plan, just like it had for the past service cost. But if this amount is less than 10% of whichever is higher out of these two, then US GAAP says this is probably just a menial adjustment, a small minor difference that is coming. In that case, no need to amortize. So corridor approach specific to US GAAP on whether or not you have to amortize the actuarial changes or not. Amortization, again, amortization is not the core focus of your syllabus. The core focus is for you to know that if financials are showing amortization, why they are there in the first place. If you get any details about amortization, although the questions are not going to focus on that because that is an accounting adjustment, not a financial adjustment. But in case you get something, the question will give you the amount of past service cost. Let's say past service cost is 2000, and let's say actuarial changes are 5000, and they both are supposed to be amortized. The question will also tell you that the remaining life of the plan is 10 years. So you will just simply have the sum of these two, 2000 plus 5000, amortized over 10 years, which means you will showcase them in OCI, but every year 700, because you're splitting 7000 in 10 years, every year 700 will be taken out of OCI and transferred to P&L statement. That is how amortization works. Now, as a result of these two amortizations, what ends up happening is that when you look at the income statement, if US GAAP is being followed, you have a lot more smooth earnings, which means instead of having amounts sitting in OCI, because they are transferred to income statement on a recurring basis, the income being reported is a little more smooth and stable because every year some part of cost is being added. So as such, this amortization process, as complicated as it may be, it also gives us the benefit that for you and me as analysts, it gives us a more smoother income statement to work with. Now, aside from these, the only other element that shows up in the income statement is interest earned. Because if you see, out of total cost, we've discussed these four. Now we have return on plan assets. Return on plan assets, IFRS and US GAAP, they both say that yes, this should show up as a earning in your income statement. However, the amount I have added in balance sheet is the actual interest or actual earnings you have had from the investment. But IFRS and US GAAP says that actual earnings are not going to be allowed in the income statement, mainly because your purpose of these investments is for the pension. So if in any year you've had extraordinary earnings, those should not be part of your earnings. So over here, the difference comes that IFRS says this interest is to be calculated as opening balance multiplied with discount rate. So same thing that we did for the PBO, IFRS is saying use the same rate on the opening balance of plan assets. That is the interest earned. This amount will be transferred to income statement. And US GAAP says that discount rate and the return on investment should not be same. So US GAAP is saying take opening balance and multiply it with expected return. Expected return is something that the management will have to estimate. And US GAAP is also saying this amount you can transfer to income statement. So effectively, both are giving some calculation. One is focusing on discount rate, GAAP is focusing on expected rate of return of assets. And the idea is these amounts will be transferred to income statement. Now, the key thing is both of these are dependent on opening balance and some pre-decided rate. But the actual return might be different from what these amounts are. It is possible that what I calculate from this or the second one is different from the actual return I have. If there is any difference between the return as shown in the income statement using these formulas and the return showcased in the balance sheet, which is the actual return, if there's a difference between actual and the return transferred to P&L, that difference would also show up in OCI. So, difference of actual versus expected return also shows up in OCI. So I hope all of this makes sense. From this amount, this was actual return. The expected value calculated by either of these formulas, that would go to income statement and the remaining would go to OCI. So total periodic pension cost, we know how to calculate it. We've already had discussion of all the elements. All we have to do once we have knowledge of everything is how we are going to split this value within income statement and OCI, because the sum of those two has to be equal to total periodic pension cost. Now, with all of that discussion done, let's do a comprehensive example to understand how all of these elements interact with each other.